When you say you had no money, I think in one of your later years, you spent $100 million on a data center. So at some point, you had a lot of money to be able to buy the best activities. But along the way, you didn't make any acquisitions, you didn't take any loans, you didn't have any financing until you were at a certain scale. What prohibited you from doing that?
I would say nothing except for just like, it was kind of our own culture. We just had a culture of like, we're going to keep reinvesting in ourselves. We're going to keep betting on ourselves. And, looking back, we probably should have taken on some debt at certain times. And it may have taken the pressure off. At the same time, we're also, building families and trying to establish a home and send our kids to school. There was a lot of financial pressure there, but it also kept us, living within our means. And very focused on what we were doing. So maybe that wasn't so bad either.
Well, the key to most entrepreneurs' success is the ability to delay gratification until you've reached great success. And it sounds like you had sort of disciplines from your father and values that you wanted to hold. But it's interesting. The end of the story is that in the last few years of your involvement, you sold to a private equity firm that the minute you sold to them, they started adding debt, or maybe you had just started adding debt, and that allowed growth to accelerate even at a larger scale. So talk a little bit about the entrepreneur's dilemma of not wanting to take on too much risk. But when you move into that middle growth stage, we're talking hundreds of millions of dollars, all of a sudden it all changes. You witnessed that change. What did that feel like?
Well, look, at a lot of the pressure was off of us at that point, right? Because we sold 80% of the business to Advent International, our private equity growth partners at that point in time. But I do remember, the conversation very vividly. We had closed and they're like, oh, by the way, Libby, we need you in New York, next week to help us, it was something like, 700 to 800 million in debt. We need your help selling that to the creditors and telling the story. And I was like, what? So probably didn't do a very good job of anticipating like that process. But, we were very fortunate, Michael. The company wasn't in distress when we formed that relationship. And even though we took on the debt, we were strong. We were growing our top line 15+%. I think our compounded annual growth rate was in the high teens for like almost 20 years.
I think in your book, you said it was 20% a year for over 20 years. That's Warren Buffett-like returns. It's just an extraordinary thing. Now, he's done it for 65 or more than 20. So most entrepreneurs that get into an organization like Tiger 21 will have had those kind of returns for a number of years, but to sustain that growth for 20 years was extraordinary. If I can